Good morning, welcome to CATEX-TV. My name is Frank Fortunato. This is a live broadcast from Princeton, New Jersey. Today is Thursday, September the 18th, 2008. It's 11:30 a.m. Eastern Daylight Time in the U.S., 4:30 p.m. in London, 12:30 p.m. in Bermuda, 9:30 a.m. in Mexico City. If you need to reach us during the broadcast, phone in toll-free at 1-866-67-CATEX. Overseas, our AOL Instant Mail address is CATEX-TV. On this day in history, in 2003, Hurricane Isabel plowed into North Carolina's Outer Banks at speeds exceeding 100 miles per hour. It then worked its way north up the Atlantic seaboard. It was responsible for over 40 deaths. Today's birthday, if you watch television, you know this man. James Gandolfini is 47 years old today. And now to our news. The stock market is up before we start about 34 points, which is a rarity this week anyway. A consortium of the world's major central banks this morning pumped $180 billion into global financial markets in an effort to ensure banks have access to enough cash. The coordinated action was announced at 3 a.m. this morning Eastern Time. So the U.S. Federal Reserve provide additional dollars to financial centers around the world, including $100 billion U.S. for European banks, $60 billion to the Bank of Japan, and $10 billion for the Bank of Canada. This move more than doubles the so-called swap line, which is essentially a short-term exchange of currencies available to the European Central Bank and the Swiss National Bank, and provides additional lines to central banks in England, Canada, and Japan. Those institutions in turn will make the money available through short-term loans to banks and financial firms that have become hesitant, if not outrightly unwilling, to lend to each other. Short-term loans among financial institutions are critical to the world financial system. An early morning news release distributed simultaneously by the Fed, the Bank of England, the European Central Bank, the Bank of Japan, the Bank of Canada, and the Swiss National Bank said that the move is, quote, designed to address the continued elevated pressures in U.S. dollar short-term funding. The swap lines will be available through the end of January. An action today by the European Central Bank showed the level of pending demand for dollars that actually exists. The bank offered $40 billion in one-day loans. It received requests for more than $101 billion. Initial jobless claims in the United States unexpectedly rose last week, led by a jump in filings from the state of Louisiana following Hurricane Gustav. The number of Americans filing first-time claims for unemployment benefits increased by 10,000, up to 455,000 for the week ending the 13th of September. Louisiana was able to report claims for the first time last week after government offices lost power during the hurricane 2 weeks earlier. Economists had forecast that claims would fall to 440,000. They in fact went to 455,000. Excluding Louisiana, the government says that claims probably would have fallen nationwide. Now to our update for AIG. Potential buyers are lining up for a shot at some of AIG's choicest merchandise, while rivals see AIG's problems as a chance to pick off some customers. Eric Dinello, the New York Superintendent of Insurance, says there is extremely strong interest in the core assets of these companies, i.e. the AIG companies, from other top-tier companies. The $85 billion emergency bailout agreement for AIG that was unveiled late Tuesday has prompted, according to Dinello, phone calls from insurance companies executives to him who want to talk about buying some of AIG's assets. Germany's Allianz, France's AXA, Italy's Generali, Switzerland's Zurich Financial, and Munich Re are interested likely in parts of AIG's business. American companies interested may include MetLife as well as Allstate. AIG's losses are concentrated mostly in its derivatives business, which holds more than $50 billion of subprime-backed securities that have plummeted in value. The balance of the company is profitable. Top candidates for sales would include the company's aircraft leasing business, its wealth management and variable annuities business, and some of its property insurance businesses. Alex Tadmori, a vice president for FM Global, said the still strong euro gives European insurers buying power, and many are looking for ways to increase their market share. A spokesman at Munich Re said the company may be interested in AIG's Eastern European primary insurance. Representatives for the other companies declined to comment. Speaking of Superintendent Dinello, he's been in the news somewhat. He will oversee an NAIC task force created to expedite the approval of AIG Group asset sales. Creation of the task force was approved by other commissioners Tuesday night. The move implies that prompt action to sell AIG assets and pay off the government bridge loan is necessary to get the best value for the government and shareholders. Dinello also said he had great confidence in the appointment of Edward Liddy, former Allstate CEO, as the new CEO of AIG. Dinello characterized Liddy as, quote, a sterling insurance executive with great competency. Dinello confirmed that a Chapter 11 bankruptcy filing would normally have been an appropriate way to deal with AIG, since it was the lack of liquidity in the holding company rather than any insolvency in AIG's operating units that caused the problems. But he said such an action was ruled out early on because regulators were concerned that it would have created a perception in the eye of the public. Of course, there's other news. Hank Greenberg, who ran the company for almost 4 decades, was interviewed by Charlie Rose last night on PBS, Public Broadcasting System. He said that AIG was faced with a host of liquidity problems brought on by the firm's failure to practice sound risk management. Mr. Greenberg said that at the time he left AIG, its financial products division had a small book of collateralized debt obligation business and strong risk management controls in place. He said that growth in that business took off after he was forced out in 2005. Quote, obviously, a lot of that risk management business either disappeared, a lot of the risk management safeguards I put in place either disappeared or were set aside or no one paid attention and they just started doing things while no one was watching, Greenberg said. Quote, there was a breakdown in the controls that had been established. AIG did not get to where it is without good risk management controls. Without naming names, of course, Greenberg blamed his successor, Martin Sullivan, for either not understanding or overseeing the development in that book of business. Mr. Greenberg said he was at a loss to understand why it happened. I'm not there, he said, so I can't answer what happened. If I were there, this would not have happened. Chris Hitchings, a well-known analyst in the reinsurance industry, now working with Keefe, Bruyette & Woods, was interviewed. He said that opportunities at Lloyd's are likely to increase as a result of AIG's difficulties. According to Hitchings, it's hard to see AIG problems as market-changing events for the property and casualty sector. However, he said that for Lloyd's, they could face a considerable increase of business. It would probably represent a substantial opportunity for Lloyd's insurers. He went on to say that it was now unlikely that AIG capacity would be removed from the market, but its downgrading by the ratings agencies may not be reversed until the ownership of the various parts of the group is determined. Hitchings said that this would most likely be from the high-risk end of AIG business, particularly in the U.S. excess and surplus lines market, due to customers in high-hazard business being more sensitive to ratings and AIG's substantial share of the market. Ergo, increased opportunity in this sector for Lloyd's syndicates. He's probably right. In other AIG news, it was announced this morning that Kraft Foods will replace AIG in the Dow Jones Industrial Average effective Monday. Dow Jones announced this early this morning. Dow did not add another stock in the financial sector because of, quote, the extremely unsettled conditions in that sector. The 112-year-old blue chip index was previously changed on February 19, 2008, when 2 of its 30 components were replaced. And throughout all this, President Bush has announced that he has canceled trips that he had planned today, fundraising trips down to Florida and Alabama. His spokesperson said that the President will continue to work with his economic advisors on the serious challenges confronting U.S. financial markets. I'm sure that's a relief to everybody. He also went on television about half an hour ago and said that he's going to do whatever it takes to solve the market problems right now and bring confidence back to the economy. It's a common refrain. It's also being echoed in Moscow. Russian financial markets remained in flux today as a halt in stock trading on their major exchanges continued today. Russian Finance Minister Alexei Kudrin offered the